Hey everyone, welcome back to the channel. I'm so glad you're here today because we're diving into something that's hit close to home for so many of us in the trading world. If you've ever felt that burning urge to jump back into a trade right after a loss just to get even, then you know exactly what I'm talking about: revenge trading. Oh man, it's one of the sneakiest, most dangerous psychological traps out there. It can turn a bad day into a total wipeout, and I've seen it happen to the best of us, including myself back in my early days. Look, trading is tough enough with all the market volatility, charts, and strategies, but when our emotions get involved, that's when things really go sideways. Today, I want to walk you through this trap with a lot of empathy because, hey, we're all human. We'll break down the emotional cycle that leads to revenge trading, that critical moment when you lose your objectivity, the telltale signs it's kicking in, why we feel so compelled to win it back, and most importantly, some clear mental rules and checkpoints to stop the spiral before it drains your account. My goal is to help you recognize it early and protect what you've worked so hard for. So grab a coffee, get comfy, and let's chat about this like friends, because I've been there and I get it. First off, let's define revenge trading in simple terms. It's that impulsive decision to enter a new trade, or worse, double down on a losing one, purely out of frustration or anger after taking a hit. It's not based on your strategy or analysis. It's all about getting revenge on the market for wronging you. Sounds dramatic, right? But that's exactly how it feels in the moment. The market isn't a person, it doesn't care about your feelings, but our brains trick us into treating it like an enemy we need to conquer. And here's the kicker: revenge trading isn't just a one-off mistake. It often spirals into a chain of bad decisions that can erase weeks or months of gains in a single session. Now, to understand why this happens, we need to look at the emotional cycle that leads up to it. It all starts with excitement and confidence. Picture this: you've done your homework, spotted a great setup, and entered a trade feeling on top of the world. Your heart's pumping a bit in a good way. That's the thrill of trading we all love. But then the market moves against you. Maybe it's a sudden news event or just bad luck, but your stop loss gets hit and boom, you're out with a loss. That's where the cycle kicks in. The first emotion: disappointment. Oh man, that didn't go as planned. It's normal, losses are part of the game, but if you're not careful, disappointment morphs into frustration. You start questioning yourself. How could I miss that? The market's being unfair. Frustration builds pressure, and if you don't step back, it turns into anger. Anger clouds everything. It's like a fog rolling in over your rational mind. And from anger, that's when desperation creeps in. You think, I can't end the day like this. I need to make it right. Boom, revenge mode activated. I want to pause here and say, if this sounds familiar, give yourself some grace. Our brains are wired for survival, and in evolutionary terms, losses feel like threats. Back in caveman days, losing resources could mean starvation, so we have this built-in fight or flight response. In trading, a loss triggers that same instinct: fight back. But the market isn't a saber-toothed tiger. Fighting it emotionally just leads to more pain. It's okay to feel these emotions, they're human, but recognizing the cycle is the first step to breaking it. Speaking of which, let's talk about that pivotal moment when traders lose objectivity. It's sneaky because it doesn't announce itself with a big red flag. Usually, it happens right after a loss, when your adrenaline is still high. Objectivity means sticking to your trading plan, predefined entry-exit rules, risk management, and no emotional overrides. But in that moment, you shift from "what does the chart say" to "how do I feel about this?" You might start seeing patterns that aren't there, or convince yourself that this time it'll be different because you're still stinging from the last trade. I've chatted with so many traders who describe it like this: one minute you're calm and analytical, the next your mind races with justifications. The market owes me, or I know this stock better than anyone. That's the switch, when emotion overrides logic. It's like driving a car. If you're objective, you're in control with both hands on the wheel. Lose it, and you're swerving all over the road. And trust me, friend, we've all swerved at some point. The key is catching it before the crash. Now, how do you know if revenge trading has actually started? There are some clear behavioral signs to watch for, and spotting them early can save you a ton of heartache. First, increased trade frequency. Normally, you might take 2 to 3 trades a day based on setups, but suddenly you're firing off 5, 10, or more in a row, chasing any opportunity to recoup losses. That's a red flag. Second, bigger position sizes. You think, I'll just risk a little more this time to make up for it, but that's breaking your risk rules, maybe going from 1% of your account per trade to 5% or 10%. Oof, that escalates the damage fast. Third, ignoring your strategy. You're entering trades without waiting for confirmation signals or holding losers way past your stop loss because it'll turn around. Sound familiar? Another sign, physical cues. Your heart's racing, palms sweaty, maybe you're muttering under your breath or slamming your mouse. Emotionally, you might feel a rush of excitement mixed with anxiety, not the focused calm of a good trade. And let's not forget the mental chatter, just one more trade to break even. If you're hearing that loop in your head, revenge trading is in full swing. I remember a time when I ignored these signs and turned a small loss into a big one. It hurt, but it taught me to pay attention. If you're seeing these in yourself, don't beat yourself up. Awareness is power. Okay, so why do we feel so compelled to win it back? It's a mix of psychology and biology that's honestly fascinating and a bit heartbreaking. At its core, it's loss aversion. Studies from behavioral economics, like those by Kahneman and Tversky, show we hate losses about twice as much as we love gains. A $100 loss stings way more than a $100 win feels good. So, after a loss, our brain screams, "Fix this now to avoid that pain." Then there's ego. Trading can feel personal. A loss bruises our self-image as a smart trader. We want to prove we're right, that the market was wrong. Add in the sunk cost fallacy. You've already invested time and money, so quitting feels like failure. And dopamine plays a role too. Winning releases feel-good chemicals, so after a loss, we crave that hit, leading to impulsive trades. In a sympathetic nod, I get why it's compelling. Society tells us to never give up, but in trading, persistence without discipline is disastrous. It's like gambling. The near miss of almost winning keeps you hooked. But remember, the market doesn't keep score on your ego, it just moves. Understanding this compulsion helps us forgive ourselves and move forward smarter. All right, now for the good stuff. Clear mental rules and checkpoints to stop the spiral before it causes real capital damage. These are like guardrails on your trading highway, simple but life-saving. First rule, implement a cool-off period. After any loss, force yourself to step away for at least 15 to 30 minutes. No screens, no charts. Go for a walk, breathe deep, or journal what happened objectively. This breaks the emotional momentum. Checkpoint 1, ask yourself, am I trading my plan or my pain? If it's the latter, stop. Write down 3 reasons why the next trade fits your strategy. If you can't, don't enter. Second rule, set a daily loss limit. Decide in advance, say 2% of your account max per day, and when you hit it, shut down. No exceptions. It's like a circuit breaker in your brain. Checkpoint 2, monitor your risk per trade. If you're tempted to size up, pause and visualize the worst case. Can I afford this loss emotionally and financially? If no, walk away. Third rule, use a trading journal religiously. After each trade, note your emotions. Over time, patterns emerge, helping you spot revenge triggers early. Checkpoint 3, the what-if test. Before entering a revenge-like trade, ask, what if I skip this and wait for a better setup tomorrow? Often, the answer is relief. Markets will always be there. And a bonus, build a support system. Talk to a trading buddy or community about tough days. It normalizes the struggle and provides accountability. I promise, using these consistently turns revenge trading into a teachable moment. Whew, we've covered a lot today, haven't we? Revenge trading is brutal because it's so relatable, that emotional cycle from disappointment to desperation, losing objectivity in a flash, those behavioral signs like oversized trades, and the deep compulsion to win it back. But with awareness and these mental checkpoints, you can stop it before the damage hits hard. If this resonated with you, hit that like button, subscribe for more trading psychology tips, and drop a comment below. Have you ever fallen into revenge trading? What helped you out? Remember, trading is a marathon, not a sprint, and protecting your capital and your peace of mind is the real win. You're not alone in this. We've got your back. Thanks for watching, take care, and trade smart out there. See you in the next video.